In Chapter 3, we're going to be talking about the role that judgment plays in proper accounting and financial reporting, and the research methodologies that accountants can use to find what is the gap prescribed proper treatment for any one given accounting situation. Gap is not cut and dry. There's a lot of situations where they allow multiple alternatives for the way that something can be accounted for. Depreciation is the low-hanging fruit for this. There's a lot of different depreciation methods that you can choose, and you should pick the one that best matches the actual way you're going to use the asset that's being depreciated. That's judgment. So you would need to go through, look at the situation, and use your best judgment as an accountant to find the different alternative that best matches the substance of what is happening to help you present accurate information when you report. Other situations that could occur is the company will have an event happen. Do they need to report it right now according to the rules of GAAP? There's some leeway in when you would recognize an expense uh, under different scenarios, which scenario matches what's happening to you. If you do report it, if there's different methodologies, which methodology are you going to use, which matches the substance of what is happening? And if there's variances in the way that you can report the valuation of it, what amounts should you report to represent the value of the asset, the actual amount of liability you're going to have to pay to get out of something, the change in the valuation of your business overall. All of these different things can be changed in the amount that you record based upon what your judgment is telling you, which presents a problem. The goal of accounting is to report something based on what best reflects the economic reality of your company. But that being said, all accountants know that you can manipulate or manage your earnings using these different alternatives. Some lead to higher expenses, which will reduce your earnings during the period. You pay less taxes. Some different alternatives that you have cause you to put an asset on the books for more value than another alternative that you would have, which would increase what your balance sheet looks like. So even though the overarching desire of the conceptual framework is to have accountants pick what is best for them, in practice, you are able to manage your earnings by the different methodologies, estimates, valuations that you choose. Problem with that is it makes it very hard to compare one firm to another. If you're a soft drink company, if you're Coke versus Pepsi, if you're using just a entirely different set of accounting treatments in there, it makes it very hard for a potential investor that wants to invest in a soft drink company to determine which one of those two is the better. And if internally to the company you keep changing your methodologies to suit your needs over time, it makes it very hard to see what the actual trend of your company is. Is the profitability really going up from period to period because you're getting better at your operations and you're doing more business? Or is the profitability going up period to period to period because you just keep switching to different methodologies according to your judgment that you know are going to help you manage your earnings and increases? So is it real or is it something that's manufactured in the accounting process? There are assumptions that you are going to have to make, and that is basically what is the nature of the thing that we're going to use. If you're choosing your depreciation method, what is your assumption about the pattern of use of the asset that you're depreciating? Are you going to use it fairly regularly over time? Well, if that's the case and you assume that that's going to be how you use that asset, you probably want to use a depreciation methodology that depreciates it fairly evenly in a straight line, if you will, over time. Whereas if you have an asset, like a car is a good one right here, that loses more value the more that it gets used, maybe you want to use something like a units of production depreciation. So it's all about the assumptions of how that usage is going to change over the entire life of the asset. And speaking of estimates, and the life of the asset is an estimate. How long are you going to be able to use something for? If you're spreading the cost of an asset out over the entire life that you use it, if you assume that you're going to use it for a very short period of time, you're going to be taking big chunks of depreciation expense. Whereas if you assume that you're going to be using it for a decade, those chunks of depreciation expense that you recognize every period get smaller and smaller and smaller because you're spreading that cost out over more accounting periods. So assumptions and estimates have a big role in what you are going to record on your income statement of your financial statements for your profitability during the period. Which is why when you report for the sake of comparability of the users of your financial information, you are required to disclose via footnote what your methodologies are. And that lets someone, back to my Coke versus Pepsi example, someone who is looking to invest in those two different companies know the methodologies that they use, and they can, being reasonably informed, know if a company is using income increasing or income reducing policies more than the other one. Helps you compare one entity to another. And there's a whole lot of differences. And here we got four companies. We got Johnson and Johnson, we got Pfizer, we got GlaxoSmithKline, and we got AstraZeneca. And all of these, as you can look down the list here and see, have some different estimates. Johnson and Johnson and Glaxo use FIFO, while the other two use AVCO, or average costing. Even though they're all using straight line depreciation for their assets, there's different estimates in how long they're going to be able to use a particular asset for. Pfizer seems to think that they're going to get more use out of a building than, say, Johnson and Johnson would, which means that their depreciation schedule is going to be very different, so on and so forth. So when you report, you need to disclose in here your methodologies that you use, the different accounting treatments that you have, and what your major assumptions and estimates are for the assets that you have on the books. An accountant wants to, by nature, provide the best information that they can. And even if they are honest people and they're not trying to manipulate the data or the financial information that they have to make their earnings look a super way, doesn't mean that they are going to be perfect. It's just in our nature that we have bias, that we find ourselves in a situation where we might do something for reasons other than the goal of providing the best information possible. Management, it's really hard for them to go through and sign off on the fact that you had a very bad period because it reflects badly on them. Even if they know that's the honest thing, they also know that that's, not a spot that you want to be in. And it's human nature to just kind of want to protect yourself. So they might encourage accountants ever so nicely to, hey, I think we should probably do this. Some situations are incredibly complex and are difficult to account for. And if there are different variations in the way that we can account for something, if one of them is mildly complex and one of them is incredibly complex, we got a lot of stuff to do at work when we're accountants. We won't have to spend hours and hours and hours going through this complex methodology. It's kind of in our human nature to be like, yeah, I think this one's good enough, and it's only going to take me an hour to do these calculations instead of 8. And then the last one was a big one, which is highlighted as cognitive bias. And that is, according to definition, the systematic deviation from rationality, deviation from what is normal. A person can have all the information that they need, and they'll know that this is the normal way that things operate. But at the same time, they're not the way that you want things to operate. And it's just human nature to be an optimist, to assume that things are going to be better than they are, or that things are going to work out. When you buy a car, you don't assume it's going to blow up after 75,000 miles. You might be real optimistic and think that you're going to drive it for 300,000 miles, even though the last bunch of cars you had came nowhere near that number. We have a cognitive bias in this case to differentiate from what is normal because we want to have positive things happen to us, which is why, as an auditor, if you're looking at a company's financials, you should exercise what they call professional skepticism. It says here that is an attitude that includes a questioning mind and a critical assessment of audit evidence. I would rephrase that as always question everything. You know that management has the wants to make things look as good as possible. In this example up here, it says their bonuses might be tied to net income. If that's the case, management wants to have as much income as possible. There's all of these situations where people, whether intentionally or not, might deviate from what is the actual best treatment. So, as an auditor, you want to go through and look at the books and ask yourselves, why do they do this? Is it the best thing? It is your job to just assume that something has to be going on within these books and dig deep to make sure that everything is in line. Even if you like the company that you're auditing, even if you like the people that work there, you need to act in the best interest of the people that are going to be using this information and exercise extreme skepticism that these numbers are accurate. Other biases that could be affected are availability bias. If you have a small amount of data that is easy to gather, you might make an assumption or an estimate based upon that data, whereas taking more into consideration might give you a more accurate portrayal. But you don't want to go through the process of doing all of that stuff, of acquiring all that old information. So your decision making is going to be biased by the availability of data that's easy for you to collect. Overconfidence, I talked about a minute ago. You expect the best out of things, and an overconfidence in your company's ability to produce stuff cheap or manufacture a certain level of output. Your confidence in that might be higher than what is actually reasonable, and when that leads to different accounting treatments that we would have. Confirmatory bias is when decision makers having an idea of what they think is going to happen, their initial beliefs, will discard anything that's contrarian to that. If you get some evidence when you're making an estimate on something that's, hey, maybe we should do this instead of what we initially assumed, it's hard for them to be like, oh, yeah, I'm going to switch everything that I just thought because of this one piece of information. You underweigh the importance of information, which is the opposite of what your initial beliefs were. The opposite of that, I'm going to go to the second one, is anchoring bias. That's whenever you find a piece of information that confirms your beliefs in something when you're making an assumption or an estimate. When you find that piece of information that says, hey, I was right here, you put so much weight in that above other things that might be contrary. And the last one is groupthink bias is incredibly important if you are on an accounting staff that has a ton and ton of accountants working on it. If you're working with a group of 40 different accountants working for a company, and all the other 39 people are like, yeah, I think this is the best idea. It is really hard to voice your opinion as one person out of the group and be like, no, I don't think you guys are correct, which leads to a group thinking. And every member is, not is trying to avoid conflict, is trying to fit in at the workplace. And maybe there's a small group that wants to account for something a different way or make a different estimate, but they don't want to ruffle people's feathers, as they say. And so they will not raise their voice. And as an auditor, you need to go through and assume that, that's the case in here. Is because if it's something that you don't believe is correct, you have to bring the whole accounting staff together. And you can't really put the blame on a few people that are like, oh, I thought that was a better idea, but I didn't.